Welcome to the Top of Mind podcast from Altos Research. This is the show where we talk to real estate industry insiders and experts about the trends shaping the market today. Enjoy the show. Mike Simonson here. Thanks for joining me today. Welcome to the Top of Mind podcast. If you follow along with Altos Research, you're familiar with our weekly real estate market data video series. With the Top of Mind podcast, we like to add context to the discussion about what's happening in the market from leaders in the industry. Each week, Altos Research tracks every home for sale in the country, all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. People desperately need to know what's happening in the housing market right now. So if you need to communicate about this market with your clients, buyers and sellers, go to altosresearch.com and book a free consult with our team. We'll review your local market, we'll teach you how to use market data in your business, and we will get rolling right away. So let's get to the show. Today we're talking about investing in rental properties with Michael Zuber of One Rental at a Time. Michael's been a real estate investor since 2002, lived through the bubble and burst, and has recently built a really interesting business model with One Rental at a Time, which I'm excited to hear more about today. Michael is also an excellent prognosticator when it comes to market trends and the macroeconomy. I like his take on the economy as it relates to housing and what comes next. So we're going to talk about that today too. So Michael, welcome to the show.
Mike, this is such an honor. I've been following your data forever. I've had you on my show a couple of times, and this is such a treat to speak with you about this because I think it's very important.
Correct. Yeah, I'm looking forward to it. You've done a few of your videos lately that have really caught my attention, thinking about some of the big interest rate things and the implications of those things. And so I like the way you distill the data. And so we're going to talk about all that stuff today. Let's start with a background though, so people know who you are. How did you get here? And like the decades long journey. Tell me about that.
Yeah. So I think for this audience, it really starts 30 years ago. I got an economics degree, went back to school, got an MBA. When you're in economics, student follower, you really got to pick something to focus on because the economy is so big and so complex and so many moving parts. You really have to orient to something. Even the PhDs can't really look at everything. So I really chose to focus on the consumer. The consumer, as most people know, is roughly 70% of the economy. They are big enough to move the needle. And if you're fortunate enough to see where the herd is going, you can make some pretty interesting moves and predictions. So that's where it all started 30 years ago. My journey in finance started in the stock market like many people. I am old enough to remember and participate in the .com era. I turned $7,000 into 200, only to lose 80% of it, at which point I never went back to the stock market for 15 years, instead choosing to focus on real estate, specifically single-family homes. I happen to live in the Silicon Valley. Silicon Valley does not produce cash flow. So after roughly a year, I was forced to choose a new market, which I chose Central California, and I started buying homes in 2002. Ultimately, I had 7 homes in a duplex in 2006. And if you know anything about 2006, that was at or near the peak, depending on where you are. And I looked at the market and realized something was unhealthy. I knew pain was coming. I did not know how much pain was coming. We sold all of it. We sold all of our houses. And we did what's called a 1031 exchange. And we went from 8 houses to 80 units, all large, small apartments. And that's where we were sitting when the single-family home market imploded, at which time we found a way to raise private capital, buy a bunch of homes. And ultimately, long story short, after almost 20 years of investing, my wife retired, and then I retired after that from cash flow. That happened, I retired in 2018, so over 6 years ago. And I've been watching housing every day, for almost 30 years. So that's my story. And, that's a quick run through.
Excellent intro. So I lived through that, as I like to say, 2 bubbles ago, Silicon Valley. And I had that fourth quarter of 1999. I had the same, I'm a genius stock trader, and I've, 25 years since I've proven over and over again that I am not a stock trader. And so I've been through that lesson too. That was quite a journey. And in fact, it's funny because that bubble, living in Silicon Valley in that bubble, really helped identify the housing bubble. Like, where
For sure.
even, for folks who were, 2006 and 7, at that time, even where the talk was starting to happen, there was very few people who knew what to do about it.
Yeah. No, I mean, you're absolutely right. Having been in the Valley and then in the Great Recession, you're absolutely right. I hadn't looked at it that way before. The consumer behavior, the parties, the interactions you would have with people were very much can't miss, never goes down, double, triple up, add leverage. You're absolutely right. And thankfully, I didn't get burned the second time. We got out of the way.
Right,
and,
right.
Didn't
Please,
run us
God,
over.
One more bubble, I won't screw it. Yeah, it's funny because after those two experiences, I developed my little rule of thumb of how I identify bubbles. And the first one is like, oh man, you made some money. Like, good for you. You worked hard, right? And that was in the stock run-ups, in the real estate run-ups. Then the second stage is like, you're looking around, you're like, man, everybody's making money. Like, and then the third step is you go, wait, that asshole, like that guy's making money?
Exactly.
Like,
yeah.
He's not smart, and he might be kind of criminal. Like,
Yeah.
like if that guy's doing it?
Yeah.
And that's when I start seeing that. So, it's when I
Well,
look at housing now, and I'm like,
it's funny. It's funny how you bring that up because I pointed that exact thing in 2019, and that was in what now we call syndications. I'm the boring buy and hold guy. I go to a meetup. I'm the keynote speaker of 200 people or whatever, and at the end I always ask what people are doing, and everybody in that room. This is the Valley, right? So everybody has some stock money, RSUs, grants, whatever, and they're all brand new syndicators. Not only are they brand new syndicators, they're brand new out-of-market syndicators who have, oh, by the way, never owned real estate. And that led to my call several years ago to get out of the way. This syndication is going to blow up and be a bubble, and now we're living through it as well. And again, I'm a guy that takes action when I see them. So I sold apartments in 19 because I saw stupid prices. Little did I know, free money would come, and I lost out on some money. But I would argue I made the right call in 19, selling at stupid cap rates. But that stuff's blowing up right now. Bridge debt, IO. It's just another. We repeated the same mistakes in housing. Short-term debt, variable rate debt, bad assumptions, new operators, financial engineers. It's like so predictable.
Yeah, I'd love to talk more about the syndication, but you made a couple other comments along the way about your story. You said Silicon Valley doesn't cash flow.
Cash flow.
So you're talking about houses in Silicon Valley. It doesn't cash flow because the cost to buy the rent is not, it just doesn't work.
Yeah, and frankly, it hasn't worked in 20 some odd years. I mean, I would love to invest in my backyard. There are just some markets that are quote unquote appreciation markets, and some markets are cash flow. I was doing this. I was working so hard to not have to work. I mean, my initial vision, Mike, was to have 4 units at 60, free and clear. Obviously the story, didn't go that direction. But I don't want to bet on appreciation. I've seen appreciation take people out, and appreciation to me is like musical chairs. It works until there's no chairs, and somebody's going to get you. So, yeah.
Okay, so that makes a lot of sense. So, some people, buy and hold in Silicon Valley, and you've held for, you're an electrician who bought a rental house in 1982, and now it's worth a couple $1,000,000, and it cash flows because you've had it for 45 years.
Yeah, you've had it for low basis. Yeah, absolutely.
And no taxes, and you don't pay taxes on it. So, okay, so that's useful. You said you started out with a vision of having 4 homes.
I did.
And how many did you end up with?
At the peak, they call them doors, right? Because we had apartments as well, right? We ended up, our peak was 187.
187. Okay. And so now you've lived through that. Are they in all states? Where did you have?
Central Valley, California.
Central Valley, California. Okay, and then now you've shifted to one rental at a time. So you're not in the operating real estate business anymore. What's one rental at a time doing?
So one rental at a time is really, it's grown into a community because when you retire, right? So let me paint you a picture. February 2nd, 2018. I'm 45 years old. I had always dreamed of working till I was 50. Not because I needed the money, but just because it was a nice round number. I happen to be a sales guy, software sales. That means every year I would get a new quota, a new team, and all of these variables. And unfortunately, what I was given on February 2nd, which was the first day of the year because the first was a Sunday, was something I could not tolerate. And I decided to part ways with my employer in a 15-second kind of moment. So I text my wife, I head home. You would think, Mike, you're super excited. You're 45, you're good financially, and now you don't have to work anymore. For a couple of days, I mean, you couldn't wipe a smile off my face. Unfortunately, what I did not prepare for was not having a purpose. I didn't have anything to drive me to. I didn't have motivation. I did not realize how much of my life and ego and mission was wrapped up in my job, which I just threw away. So over the course of the next 6 weeks, I go from being a very positive, glasses half full person to depressed and really thinking about, suicidal thoughts because I have no mission anymore. It's just like a horrible place to be. So I was there on a weekend, probably 6, maybe 8 weeks after leaving, going, I'm just going to get a job because this is not healthy. Or I could try to do something. So what I decided that day was to write my book, One Rental at a Time. Because why? I'd never seen one like it. The book is basically, hey, I lose all this money in the stock market. I read Rich Dad, Poor Dad. Then what? It's not a how-to book. It's a look back through the lens of 20 years of investing. So that book allowed me to be positive, right? I wrote, 5 pages a day for weeks. That goes well. And then I'm on a trip in Asia with my wife because we just got to get out of here because I can't have this feeling of being depressed. So we decided to go to Asia for a month or whatever it was. And I'm in the back of the family van. My wife's family's from there. And she speaks Mandarin. And it's just loud and I don't speak Mandarin. So I put on a YouTube channel and I bump into Graham Stephan. Graham Stephan at the time is like 40,000 subs. Today he's 4 million. But he's talking about owning 3 homes or 4 homes or whatever. I'm like, YouTube's a thing? You can actually tell people what you're doing and educate them? And it was in the back of that van that day I decided to create One Rental at a Time just to help people. So One Rental at a Time is just a framework, buy box, daily discipline. You could do it. Believe in yourself. And I spend about 15 hours a week now trying to help people move forward. I have decided, I reserve the right to change my opinion, that we're not in growth mode anymore, right? We add about 1, maybe 2 units a year. So, if something comes across my plate, that's a great deal. I buy it. But I'm not as aggressive by any means because I can spend 10 to 15 hours a week helping others and I'm satisfied. I'm happy. So One Rental at a Time is simply there to help people believe it's possible and hopefully change their financial future.
Terrific. I haven't read the book yet, but I do watch the videos of One Rental at a Time. So I will read the book. I always love reading my friends' books. So
thank you.
I'm in for it. And so you were still selling software when you had 150 homes or found.
Absolutely. Yeah. And not only selling software, I was all around the world. My job was running the country, either the U.S. or the world for different, because I could have been in 3 countries in a week very, very easily.
Wow. Good for you. You have a bigger span, a capacity than I do. I was like, I'm running the company and I'm not buying houses because I'm running the company, But that's great. You mentioned Rich Dad, Poor Dad as like an inspirational moment for you.
For sure. No doubt.
That's Kiyosaki, right?
It is. It is Robert Kiyosaki.
Do you follow that guy now?
No, he is gone Looney Tunes. But you've got to give credit where credit is due. Rich Dad, Poor Dad. And it's actually a sad statement on education, frankly, because I've already shared you. I have an econ degree.
Yeah.
I have an MBA. And freaking Rich Dad, Poor Dad is the unlock. I mean, come on, folks.
Yeah.
Rich Dad, Poor Dad's the unlock for this whole other avenue of real estate. I think it's funny in hindsight, but no doubt that book's changed my life with no question.
That's terrific. Okay, that's great. And you know, it's power some excellent words, which you know you're in the business of now. So that's terrific. Okay, so you are so One Rental Time is about YouTube. It is about educating people and about building a community of people who are real estate investors. So now it's 2024.
Yep.
Mortgage rates are 7%.
Mm-hmm.
Prices are at an all-time high.
Mm-hmm.
Tell me about one rental at a time now compared to 2002.
You know, it's really funny. When you look at the market, I've looked at the market every day since 2002. I've been investing in the same market, same thing. So I will agree with you that affordability today is really, really bad. It's not record bad. Record bad's 1981, which a lot of people fail to realize. Affordability was markedly worse in 1981, but today is bad. It's the worst in 30 years today. So that's a fact. Another fact is the Fed broke the housing market. All right, what the heck does that mean? The housing market, as you know, operated in a rather structured mechanism for decades. Entry-level housing, you stay there between 6 and 8 years. At some point, your job goes up, the family gets bigger, you sell that home, and you buy the move-up home. Then you're there for 8 to 10 years, and then maybe there's another move after that. Well, that's now broken. We are going to see the lowest turnover that we've seen since the early 80s because people are just either A, they don't want to move, or worse, they won't get approved. You just won't get approved. A lot of folks at today's rates couldn't buy the house they're in, let alone the move-up house. So what we are in today that a lot of people don't get and frankly got wrong is we're in a transaction depression. This is something I called early and got right because everybody else was saying, hey, rates went up 500% or, you know, from 1% to 5%. Prices have to come down. I'm like, no, they don't. Hello, go look at 1978 to 1990. Doesn't have to come down, but transactions will. And I called it really early that transactions would fall roughly 50%, and they have, right? The lowest mark was 3.79 was the lowest annualized monthly number. So the first thing to realize is we're going to be in a transaction recession for several years, probably the next 3 to 5 years. We are not going back to 5.5 to 6 million existing home sales for the foreseeable future. So that's the first thing to realize. Turnover is going to go up. We've talked about that. But now we need to talk about price. If you look at what builders have been doing since the Great Recession, they have on par been building big homes, luxury homes, because that's all that penciled. And, the well-off home buyer were the ones that were buying. Unfortunately, that is now done, in my opinion, for a while. And if a home builder really wants to make hay, they need to build smaller homes. And I'm talking marketably smaller homes. I think last year, the average home was down 3% in size. I think it's going to be down 5 or 6% this year and probably down again next year. Why? Because the first-time home buyers got no choices. The Fed broke housing. The people that own the first-time homes aren't selling them. And now there's no supply to back it up. So home builders, I think right now are burning through inventory that they had planned for at a different time. And as we go forward over the next several quarters, they're going to go smaller. I think Lennar is leading the way. I think they had a 661 square foot home in San Antonio. They had a 997 square foot home somewhere in Sacramento area of El Dorado, I think, or something. So I think you're going to see builders go smaller, which, oh, by the way, is going to lead to new home prices crashing. They're not crashing. They're just smaller homes, people. Stop listening to those crash idiots. So I think builders are going to meet the market, and meeting the market is going to mean smaller homes with where we're at. So that's kind of a quick run through.
I love that insight. We have seen size of homes tick down. I like the prediction that we'll see it keep coming down the next few years. That's, I think, powerful. And, I see, we interact on Twitter, and you see people, in the Lennar homes in San Antonio, these little tiny boxes, and people deride them. They deride them as like, oh, I can't believe this. But, I bought my first Silicon Valley house was, a 1952 3-bedroom. It was 1,000 square feet. It was a 3-bedroom, 1-bath. The people that we bought it from raised a family of 5 there for 50 years. And then we bought it. Like, and then when they sold it, they went and built their dream house in Nevada, right?
Yeah.
And, and that was great. But, small, like, it's like, it doesn't particularly scare me, or like think I just a step down. Like, I mean,
let's poke at that a little bit, because we also need to realize we have some generational behavior going on. We obviously have a young millennials and Gen Z that are delaying life choices right now. If you compare them to boomers and X, they're doing things 6 years later than past generations. So what might that mean? We might see a lot more single people, and specifically women, buy homes. So, okay, if you're a single person, do you really need the classic 3-2, 2,100 square feet? No, you don't. It's probably a liability. But instead of renting, could you enjoy a 1.5, 750 square foot with your own lot and backyard for your little dog or little cat or whatever it is? Absolutely. Think about the generation in prime buying. They're behaving different. But if builders come to meet the market, which I think is sub 1,000 square feet, it's the unlock.
Yeah. Sub 1,000 square feet will be fascinating, and see if we can get, and is that an angle to help solve our affordability challenge?
Absolutely it is.
Nope.
Without question. If you take I forget what new home average price is today. I'm going to call it 400 for a round number. You start building homes that are 500 square feet smaller than average, you can whack a quarter off the price. So yes, that is an answer to affordability. It will undoubtedly allow idiots like the Crash Bros to say new homes fell 25%, but who cares? It solves the problem. Small homes solves the problem.
That's a terrific insight. How does that impact investors who are like starting now?
So you have to deal with the market you have, not the market you wish you have. What does that mean? Well, as we're sitting here today, recording this on May 15th, this is the market we have. We have a market where interest rates are 7%, as you said. We have a market with very little inventory. We have a market, as Alto's research highlights, which I consume your stuff every Monday, inventory has been building all year. However, all inventory is not equal, because if you look inside the inventory numbers, something becomes very clear. Clean, safe, move-in condition homes below the median are like unicorns. They sell very quickly and possibly over ask. What is starting to linger? What is starting to build? What is starting to see days on market rise? It's the non-perfect, outdated, older home. So as an investor, where you need to shop, where you need to look for motivated sellers, I am not looking at anything that's less than 30 days on market. If it's under 30 days on market, I don't care. So I want 30 days on market. I want non-updated homes, and I want to buy from a seller who needs to sell, not wants to sell. The thing about real estate as an investor is you actually want a slower market. So the market we are in and entering in the near future is one that is slower. And a slower market allows me to find motivated sellers. That's my job. So that's what's coming, and I'm excited about it. The last 2 years have been rough, man. You want to try to be a real estate investor when there's only 250,000 homes on the market and rates are 3%? Good luck. That's not the market I want. I want the market that's slow. So
that's slow, even though the cost of money is a lot more right now.
I don't. Yeah, I wish. You know what? You want to know something crazy? I wish the cost of money was 10%. Why do I want that? Because, Mike, I want to buy from people who need to sell instead of people who want to sell. Somebody who wants to sell will hold on their price, and they'll just take it off the market. They'll wait for a better day. But if I can find somebody who needs to sell for some life event, I can either A, get my price with a 10% cost of capital, or B, I can get seller terms. And I've been doing this long enough where I've done millions and millions of dollars in seller financing, firsts or seconds. When you're a real estate investor, it's not always about price. Sometimes it's price, sometimes it's terms, sometimes it's both. So a slower market is good. I want days on market to go up. I want inventory to build. It makes my job easier.
Okay. So you're looking at these conditions and looking back at like 2002, actually rates were, I don't know, probably in the 6 to 6.5, like about the same as where they are now. And so you're looking at for investors who are in your community as like, look, this is finally an opportunity for us to build this business again.
Yeah. So let's be very clear. In 2002, the job for me was buying turnkey properties. In 2002, the idea was to buy something that was set it and forget it because I didn't have the extra cash to do the remodel. Today, those properties are the only thing selling. So today, I have to buy a fixer-upper. I've got to negotiate a price and or terms or both that allows me to maximize. So you're absolutely right. The cost of capital roughly the same, but what I'm buying is completely different. In 2002, it was clean, perfect. Today, it's junk and dated.
Okay. So then now today, it's by the junk, it's dated. That part of the job is to A, find the motivated seller, and then B, figure out a way to make that and update the property and make it.
Yep, correct. Yeah, I mean, the beauty of this is buying something that's dated is you don't have to do a homeowner remodel, right? You could buy something where the tile is the classic 80s yellow and green, but as long as they're safe and not chipped, maybe you don't even update those. I've never gotten more rent because my tile is white versus green.
Right. Okay.
Right, so you have other options.
Yeah. Okay, that's great. Love it. Love the insights. Let's shift to macro. And, I like your views about, like, everybody has an opinion about where rates are going and why and things like that. I'm not convinced that anybody can predict where rates are going, but I'm interested in your thought process about how you get to your conclusions. And so let's talk about rates and inflation and the numbers that you care about right now. I know you've got your giant 54-year spreadsheet that you include all these things in. So tell me, let's talk macro. Tell me what's on your mind and what we should be thinking about.
Yeah, so I love this because you're absolutely right. Nobody knows where rates are going. But I think if you look back at the last 12 to 18 months, you know something for certain. Below 7% mortgage rates, owner-occs, unlocks marginal demand. Above 7%, freezes it. So where have we been the last 6 to 8 weeks? Rates have gone from 7 to 7.5. We've been above 7. We have seen at least twice and quite possibly 3 times in the last 18 months where rates went as low as 6.99 and demand came off the sidelines. So again, as I said earlier, I've studied the consumer for 30 years. The consumer is telling us rather clearly that something with a 6 on it is good and something with a 7 on it is bad. So instead of trying to predict mortgage rates, just watch the daily update. And if they go below 7 and the trend continues, we will see marginal demand uptick, which in Altos research speak, you will see pendings rise, right? You report on it every Monday. So I made a call this morning that I thought rates were going sub 7 this week. And if I'm right, you will see pendings rise 2, 3, 4 weeks out because it takes a little time in the system. And then my big call was we would see active inventory roll over in 4 weeks.
Roll over and start declining because of that.
Exactly. Yeah, absolutely. That's my call.
This is great. Let's unpack this a sec. So 7% is the threshold you see right now.
Correct.
And in the language that I use on that is that consumers have a really short recency bias.
Correct.
And so if I'm shopping at 7.3, 6.99 feels like a bargain.
Exactly. That is exactly what the consumer is thinking. There was 2 years ago when we went from 3 to 6, they remembered 3. Now they're remembering 8. It's that simple.
Exactly. And in fact, they may be remembering 7.3 because that was, 3 weeks ago, right? When I started my search. And so, but on the other hand, if it goes to 7.5, I walk away.
It's got to be, it has to have a 6 on it. It is that fine a line. 6.99 is a yes. 7.01 is a no, which is really weird because if you do the math, the difference is like $2.
It's nothing.
Yeah.
But okay. So I like that as a window. And for sure, since we've had, since March, I think it was in March, since January 1, rates have been basically climbing. And so, being in the sevens in April. So then in May, if we could, we have some momentum, the 10-year is falling a little bit. So maybe we get back under 7%. You think it's going to happen this week, which is terrific. I love having concrete, predictions in this.
Yeah, I love to make calls. I have 2 shirts, which I flaunt because I will either flaunt. It's a shirt called Nailed It if I get it right. And if I miss, which I don't mind missing, that's what happens when you make calls. I wear Swing and a Miss.
Ah, great.
I'll own it either way.
And so therefore inventory to roll over and decline.
In 4 weeks. It'll take time, to get approved, to get in. 4 weeks out. If rates go below 7 and stay there, inventory will roll over in 4 weeks. That's the prediction.
Okay. So I could see that could happen. I would say that I've maybe tempered that call with what we've had is since November, beginning of November, we've had inventory growing relative to last year.
Correct.
So even the weeks when last year was climbing, these weeks we're climbing more. So we're at whatever, 36% more homes on the market now than a year ago.
Correct.
What I could see is rates drop into the 6s. I could see that compress for the first time in whatever that is, 25 weeks or however long it's been since it's been climbing. And then we have inventory would normally peak, normally would be like August. If rates fall into the upper 6s, I would expect inventory to keep climbing, but at a slower pace and compressing versus last year rather than expanding. And then unless it falls more dramatically, like rates fall 6.5, then I could see us peak in inventory earlier this year.
Let's poke at that a little bit. Because again, so as you know, but for the audience, the other thing we've been dealing with is a wide gap between historical spread on the 10-year and mortgage bonds, right? It peaked at, I think, 309 basis points. Today, I think it's at 265. Average is 180, historical average. So if we have banks, which are hungry for loans, if we have bank presidents and, the banking system realize that the Fed's no longer going up, one of the reasons we had this spread is nobody knew where the bank was going and they wanted to remove refi risk. Well, now that's coming off the table. We just got a low CPI print, lower than expected. We have weak retail sales. We now have the Fed looking good not to raise, right? That's now off the table. Rate cuts are at least in the thought process. So even if rate cuts don't come this year, the bank, you could see the spread come in another 0.5 point all by itself.
Right. So yeah. So and part of the spread is the uncertainty in the changing rates. And so
Correct.
Even if rates start staying stable, then that uncertainty starts to ease. And so the spread comes back down and compresses.
Exactly back. Right. Exactly. So you could see 6.5, probably not in a month, but you could see 6. I'm not calling that. I'm just saying it.
Yeah. Right. It could be in the mix. Okay. So let's talk about the Fed and Fed funds and what we see and what we should look at there. So you said, low CPI today. The PPI was yesterday, right? Like it was
correct.
And that one headline was hot, but then in the components, it actually turns out it maybe wasn't that hot in the bond.
More mixed than the headline looked. Yep.
Okay. And so the 10-year fell actually, yes.
Correct.
Okay. So then what am I thinking about in inflation and rates and what should I be paying attention to for the rest of the summer?
Oh, for the rest of the summer, rates are the Fed isn't going anywhere. The Fed, my current best guess is the Fed cuts after the election, which I believe is like November 7th. That's their first meeting in November. So no cuts till November is my current best guess. And it'll be one cut this year.
Okay. And what does that mean then for the rest of us? Like, what's the downstream of that?
Well, I think the downstream of that is the market finally realizing the Fed is serious because, again, the Fed came into this year saying, I'm not cutting, and the market said 6, right? So I think the market finally catches up, and we finally start to normalize rates because, again, I think the market right now is anticipating 2 cuts, which is a lot closer to 1 than 6. But I think we really have to be concerned about, a I think the biggest risk for us is something you and I experienced as kids, and that was stagflation. You and I were alive, but we were kids during stagflation in the 70s. That's a real risk, right? We could have below trend growth and sticky inflation. That's a recipe for yuck. That's my current concern is stagflation is looking more and more like a base case.
Yeah. And in a stagflation world, what happens to housing?
Well, again, we have historical precedents, folks. You talked about the 54-year spreadsheet. The answer is on there. Transactions stay muted. Prices, when adjusted for inflation, go nowhere. But nominally, they go up. I mean, that's what people don't realize. We had the most unaffordable market ever in 1981, and prices went up, nominally speaking. So again, it's just a yuck. Transactions down, adjusted for inflation, nothing. It's just, we got to pay for the sins. A lot of debt out there. It takes years to work through this stuff.
Great. Talk to me about your view about employment.
Oh, I would tell you the number I'm watching is 4.2%. Right. Today, I think the last reading was 3.9. I know there's a lot of people that think 4%, the psychological round number, is a problem. I don't think it is. I think 4.2 kicks off something called the Psalm rule. The Psalm rule simply said is anytime employment is up 0.5% from the preceding 6-month average, a recession happens. And today, given the calculation, 4.2 is the magic number.
I love that you have the Psalm rule, the specifics of the Psalm rule memorized, other than unemployment is the indicator of recession. She's really, Claudia Psalms.
Really specific, yeah.
And so you think that if unemployment goes to 4.2,
that's a problem.
We'll cross the Psalm rule threshold, which says now recession's coming.
Oh, recession's here.
The recession is here, right? This is the onset of the recession.
Correct.
Okay. And, so you're watching, so the one that really matters is 4.2 because then it'll be above the threshold.
Correct.
And that would mean...
That'd be a problem.
That's our problem, like now a recession. Yeah. Okay. So, and unemployment can move quickly. That number can move quickly.
Oh, yeah, absolutely. Yes. Typically speaking, if you go back and look at the unemployment chart, which people can on the St. Louis Fed, when it breaks, it's a elevator. Yeah.
It's a spike. Yeah, it's a real spike there. Have you thought about, so I've got let me run this by you. This is top of my head. I have a hypothesis about the employment market right now.
Okay.
And in real estate, we talk about the lock-in effect, the mortgage rate lock-in effect. I have cheap costs. I have a good thing. If I make a move, like now my costs change. And so, there's a lot of reasons transactions are down and we're starting to come out of that. But we have a muted market because costs were super cheap and making a move now makes them expensive. I see parallels with the employment world. So unemployment is low.
Correct.
But also hiring is low. So it's like we're not buying and selling on the people on the employment side as well. It's like both of these markets are locked in to pre-pandemic goodness. And we don't want to make these big moves. So even though unemployment is low, actually hiring is really low too.
Yeah.
What do you think? Do you see those parallels?
I do think there's parallels. And again, I was a leader and responsible for hiring, the last 15 years or so of my career. And that included recessions. There are some times when executives make the choice. It's like, we won't hire, but we're also not going to fire because we anticipate coming out of this. And it's very expensive to retrain and lose that IP. So yeah, there's probably a lot of validity in that. There are probably a lot of companies that won't be hiring, but also won't be firing. Because again, the down cycles typically are 9 to 18 months where the up cycles are 8 to 10 years. So there's probably a lot of that going on.
Yeah. So then, we did a little bit of prognostication, rate cut after the election. You're thinking, I love your call about size of homes declining by 5 or 6% per year for the next couple of years. What else do you see for 2025 and beyond?
Yeah. So if you're talking real estate investors, the opportunity, Grant Cardone says lots of crazy things just to say them. But I do agree with one thing that he's putting out there, that we could have the greatest generational wealth opportunity coming, but that's going to be in multifamily. That's going to be in commercial. And we talked about this a little bit earlier. We did the same stupidity in commercial. And now we got to pay the price. The debt's coming due. Commercial banks are sitting on this. They can't extend and pretend forever. We're seeing buildings, if you watch Real Deal, that are trading for 90% off. We just had the tallest building in Fort Worth, Texas, go for, 15 million when last sold for 150. I mean, just crazy things are happening. Some people are going to make a lot of money cleaning up the pieces in commercial. Unfortunately for the crash bros, I think prices are basically flat. My call for single family is basically existing home sales is we had all the appreciation we're going to see for the decade in the first 3 years. So it's basically going to be flat until 2030. We'll reevaluate then.
In terms of
price, median price
flat for the decade.
Yeah, for the rest of the decade. Yeah.
Yeah, that's a strong call, and I don't disagree strongly with that call. Like I see a lot of those factors for the decade. And that is, are you thinking nominal or real prices in that sense?
I'll go real. I mean, just like the 80s. I mean, people don't like it, but there's a good chance we follow the 80s. So we might be up nominally, but again, if you strip out inflation, we're going to be basically flat.
And you said that you expect 2 or 3 years of the transaction volume to be muted. And so, do you see any growth in that, like this year and next year?
I'm sorry, do I see what?
Any growth in transaction volume in this year?
I forget what we did last year. I think we did like 4.1 if you or the full year. I don't think we're above 4 or 5, Mike.
Yeah.
Until like 2027. 2020,
okay.
Yeah, 2027.
Okay. Those are great. Really, those are nice, precise, and I think well-founded views of the future. Let me shift gears a little bit. What do you think are maybe things that people are getting wrong, like the headlines are getting wrong, or, I like to call out and you've been pretty clear on some of these things, that your view on some of these, but are there things that, are there assumptions that I'm making that you think, I should reevaluate?
I love what Altos research out, because part of being good at housing is consistency. And that's what you're remarkable at it. If you only look at it once a month, that's not every week, every day, right? This, because it does tell you things, right? And, I love the stats you have, right? You talk about active inventory, number of new listings, how many went immediately pending, current pendings, price cuts. Those are all interesting. If I had one ask, and it's probably tough to do, I think we have a bifurcated housing market. It's being lost in the numbers. I want to know the numbers below the median for a market and above the median. Because my evidence from talking to people on the ground across the country is clean, pretty properties below the median sell fast and sell above ask, where the luxury stuff, 1.5, 2x are sitting and having price cuts. So for example, it's one thing to say you have, I forget the latest number, 33.7% price cuts. My guess is you have like 45% price cuts above the median and you have 21% below the median. That's a distinction worth exploring, in my opinion.
I can do that. In fact, in the Altos data, we track every zip, city, state, every metro we track in 4 price range segments. So cool. We can track the high end of the market behaving differently from the low end. And in fact, back to our original part of the topic, in 2006, 2007, Silicon Valley, when I had just started Altos, we could watch when subprime broke, the subprime lenders broke, we could watch San Jose, and I could watch, normally, if you watch days on market per price range, you can imagine more expensive stuff takes longer to sell.
Correct.
And so you can imagine that happening. When subprime broke and the top of Silicon Valley in 2006 was like, $1 million and the bottom was 350, but all the 350s were all subprime loans.
Correct.
And they were all garbage, really junky old
really
houses.
Toxic, bad.
Yeah. You couldn't get a loan for those anymore, but you could still get $1 million loan without even blinking.
Correct.
And so we watched the days on market invert for those price segments like that. And it was really fascinating at that time watching that for like San Jose. And you could see, that where the demand was happening. And so one of the things that'd be interesting to see, I will try to tease some out of that and see if I can to get some examples. We also have regional things happening.
Correct.
Right now. And if, for example, Florida has 63% more homes on the market than a year ago. 63%. And actually Arizona's up to 60% more now.
Wow.
Yeah. Texas is about 50% more. But, New York still has fewer homes on the market than a year ago.
Yeah.
And if you're shopping in, upstate New York, there's nothing available. Now, it's about to cross over, and even New York is about to go positive versus a year ago, but it is a dramatically different market there. We're also seeing, I think, cash-heavy markets. So some of the Orange County, California stuff where people, or, San Francisco, they are cash buys and going quickly because the cost of money is more expensive. So there's regional things going on as well.
For sure. Absolutely.
Okay. So let's talk about longer term future. We talked about a little bit of, prices flat for the rest of the decade. You mentioned generational wealth transfer. And so in that one, you're saying in the generational wealth transfer, you're saying look, we're going to have these massive price cuts on apartments that got funded with short-term rate financing, and their costs are out of whack. So they get sold. And so you think that there's big opportunities. And that's what you mean by generational opportunity. I'm buying something at a 90% discount right now.
Absolutely. And again, it'll be out there for the small people. It's just not houses. It's 5 to 40 unit buildings. That's where I'll be playing.
Right.
I bought and sold those before. I've been through this cycle before. There was a building we bought in the Central Valley that was once listed at 1.5. We bought it for 700. It's coming around again. And this time I'm more prepared. So the other thing, again, if you want to talk single family homes, there are a couple of markets that are getting nuked by Airbnb, changing the rules, like Palm Springs and others. So there are pockets where if you happen to be an astute shopper, you can find deals, but we're not going to have a national housing crash. That's just not coming. It's not in the cards. The debt structure is not set. We could see unemployment go to 5.5%, and single family won't crack. Right? If unemployment went to 7.5% and stayed there for 2 years, that'd be a problem. That would be a problem. But that's
right.
It's not happening.
That's not happening. Okay, so and we talked about that I love the perspective of starting 20 or 25 years ago and starting now. One of the assumptions of 20 years ago was we had growing population, we had boomers in peak home buying years, and then we have millennials. What about the 2030? This what do you see?
I have some very base thoughts on this. There's really two things. One, inflation is a feature, not a bug. If you understand inflation is a feature, not a bug, you invest some way. What's the best way to do that? You find an asset that you can have fixed rate debt for 30 years that cash flows day one, and you hold it for 30 years. That's the single family home. That's the fourplex. Simple. Changes the way you invest. Because again, over 30 years, the debt you're paying back, which, oh, by the way, with somebody else's money is smaller. It's less. So inflation's a feature, not a bug. Second, getting wealthy is remarkably simple. You have to create disposable income. Disposable income becomes the seeds that you plant. You need to become a great investor at something. For me, that was 3 and 4 bedroom homes, 93703, 2-car garage, 2 baths, between 1,200 and 2,000 square feet. That's all I looked at for 3 years. I knew that widget, that buy box, better than anybody. And then you buy the great ones and you don't buy the others. And then lastly, do it for a decade. That's it. You do that for a decade, you understand inflation's a feature, not a bug, you win.
And so, okay. So it seems unlikely that the assumptions about inflation will change. That seems like a long-term bet. What about demographics, though, changing? What about a world where we don't allow immigration into this country anymore? And suddenly, false.
Yeah. If America locked down or became the place that the best and brightest don't want to come to, that would be a problem. Now, I happen to believe, given all, even though we have a lot of nonsense in us and them and left and right and red and blue nonsense, I still believe, and maybe it's because I live here, I choose to live here. Believe me, I can live almost anywhere. I choose to live here. That America is still the place where the best and brightest want to go. So as long as legal immigration of the best and brightest want to come here, I like our chances. But if we lock down and become just this isolation like maybe Japan or something like that, yeah, I would probably change my opinion. Then it would become very much big city, right, versus small town. Because we would just retreat in versus expand out. But those are decades in the making, right? People looking at demographics are decades, not years, decades.
Yeah. Okay. So you'd see us like in a shrinking or an isolated world, we infill basically.
Correct. We go closer and closer to employment and facilities and support, and it's basically play the clock backwards from the 1940s to the 1970s. That's what we would do. We would be going towards the city from the farms. To be reverse of that.
Cool. That's a terrific insight. This has been outstanding. I appreciate it. Every bit of the call has been terrific. So One Rental at a Time, YouTube, and also on Twitter. Any place else? Your book, I guess we can link to your book.
Yep. I've done very few things right, but one of them is One Rental at a Time, website, YouTube, Instagram, everything.
Great. I will point people there. Michael Zuber, it's really appreciate getting your take on things and precision with your views of the future. That's really useful. It's really why I wanted to have you on, because it can be so hard to make those kind of calls. And so I like that. It's been a real pleasure.
Thank you, buddy. I think it's important to make a call, give a base case, and if you're wrong, own it. I think there's a lot of people that hide from mistakes, and mistakes are just opportunities to figure out what you missed and what you learned from. So I have no problem making calls. I make calls almost every day, so I enjoy it. It's fun.
Excellent. Michael Zuber, One Rental at a Time. Thank you so much.
Thank you.
Everybody, it's the Top of Mind podcast. Thanks for listening. And as always, if you leave a review, helps other people find us, give us a bunch of stars. I appreciate that very much. And we'll be back, next week and with more guests. Thanks, everyone. Thanks for listening to Top of Mind. If you enjoyed the show, I'd really appreciate leaving a nice review on your favorite podcast app. That helps other people find us as well. Be sure to subscribe so you don't miss future episodes. See you soon.